for all of you guys, there's going to come periods of time where every single trade you look at, it hits. And you feel like you can't lose. And then you're also going to go through times where every single trade you look at, it just doesn't work. And it feels like you cannot win a trade. Both of these are going to happen to you and likely already have and will continue to happen just at a larger scale. As you continue to scale with bigger and bigger numbers, and as you trade for longer, the streaks are likely to become more extreme. Okay, now, obviously, there's positive drift involved. So as you trade longer, you get more screen time, you get better, you have edge. So the streaks that are fun, where every trade you look at, it seems to work, it's also going to be dependent on the price action, of course, but those will come a little bit more frequently than the bad streaks over time. But now there's nuance, right? Because if you are very experienced and the market is trending beautifully, it becomes more and more likely you're going to have a wonderful streak. Whereas on the other side of that spectrum, if you're not all that experienced and the market is ranging hard and lower volatility, it becomes more and more probable that you're going to have one of the bad streaks. Now, here's how you handle them. Okay, first of all, do not ever do your best to never get high on your own supply. Okay, when you're on a winning streak, it is crucial. It's non-negotiable that you continue to remind yourself that, hey, this is my experience lining up with the current market environment, and there's probably a little bit of statistical anomaly mixed in here. This is great. I'm having fun. But when I have a losing trade, or when the streak seems to cool off, I'm okay with it because I know what's going on. Now, on the other side of that coin, this is the tough one. When things aren't going so well for you, and you're on a losing streak, and by the way, this could be intraday, this could be a week, this could feel like a whole month maybe. There's different time scales that we're talking about here, but a losing streak nonetheless. I need you to slow down, look at the market environment. Because the last thing we need happening to you is you take 15 trades in a row, and then it's 3 o'clock, and only then you look back and you're like, whoops, we were in a tight trading range all day, and I bet on 15 breakouts in a row, which is why you lost 14 today out of the 15. Oops. We don't want that happening to you. That was what was your mistake, right? You forgot the top-down nature of RAM as a methodology. You forgot context, okay? But if you take a step back after losing, let's say, 3 trades, 4 trades, maybe 5 in a row, you're like, oh, what's going on? And you're able to see, you're like, oh, I see. Things are developing more. I didn't see it in the moment. This is a trading range. Or maybe, it was a trading range. Here is actually a pretty good example. You had a trading range and then a push downside that ended up turning from an attempt into a trend on, 49. And then we had 50, 51, 52, 53 into more of a soft bear channel that later tried again to turn into a trend that bounced hard, right? I wouldn't say hard, it bounced. Depends what scale you're trading on and whether that's hard or not, right? There's a difference between ignoring context and getting, we'll call it, unlucky. And what I mean by unlucky is not you took a bunch of trades that had no edge over a large sample size. What I mean by unlucky is you took a very small sample size of trades and they happened to not work. Every full-time professional in this industry, when I say that, it is all too familiar to them. Okay? We're all on the same page. We know that these things happen, and they will sometimes come in batches because of the side of market environment, right? The context. Beginner traders and even intermediate traders will struggle with this. And I don't want you to struggle with this to the best of your ability because I need you to remind yourself when you cannot lose, hey, this is my experience mixed with the current market environment, sprinkle a little statistical anomaly on top, and we're cooking. We love it. On the flip side, same deal. When you're losing, look at it for what it is. Say, you know what? I'm doing my best. I'm looking at the context. I'm not ignoring it. I'm taking good trades. I'm not letting the emotions slide and get in the way. They just didn't work. And you look at it, you sprinkle in a little bit of anomaly on top, and you say, okay, it goes both ways. You're going to have periods where you lose 4 or 5 trades in a row. It's going to happen. Hate to be the bearer of bad news. That is not that big of a deal. 4 or 5 trades in a row? You guys, it's not unheard of. Traders making many millions of dollars a year, losing some insane number in a row, 14 trades in a row. They're like, yeah, what a great start to my year. I've lost 14 in a row. This is going to happen to you. Okay, now ideally that one, when I was told that story, I'm like, that's quite the anomaly. Because I knew they were a skilled trader. But I'm like, okay, it's an anomaly. You keep pushing. And they eventually dug out and it was totally fine. It wasn't a big deal. They didn't get in their head about it. They're like, this is just more almost comical than anything. Because they were sure of their edge. It's not a big deal when you're sure of your edge. When you're not sure of your edge, that's problematic. That's problematic. Because when you go on a losing streak that isn't extreme, maybe you lose 5 or 6 in a row, and you might feel like, Nico, that's pretty extreme. No, it's not. No, it's not. You're going to have winning streaks where you win 14 in a row. 12, 15 in a row. And you know what beginner traders do? They don't get confident. They get straight up blind cocky. That's not a situation you want to be in. You want to be the most confident trader of all time. You don't want to be blind cocky. The market will humble you real quick. Real quick. But it's going to happen both ways. You'll have streaks, you lose 5 or 6 in a row. You'll have streaks, you win 10, 12 in a row. And maybe even more extreme than that over a long, multi-decade career. And that's okay. Okay, the important part is, no matter what side you're on when you're watching this, win or lose with a streak, take a step back, stick to the methodology, understand that, hey, there's some anomaly mixed in here. On the winning side, just accept, okay, screen time by experience, plus a beautiful market environment, plus a little bit of Statistical anomaly in my favor. We're killing it. That's great, but I'm just going to keep taking one good trade at a time. On the losing side, you look at it, you say, I'm sticking to the methodology that I know works for me. I'm not ignoring the context here. I'm reading it properly, at least to the best of my knowledge and within reason. You know, you're not blind. What I mean by that is you're not blindly ignoring it. Like, for example, a single bar sideways trading range that you bet on a breakout 20 times in a row and lose, 18 of them. That would be ignoring context. You got to be making a reasonable effort to understand, okay, what is the context of the market and what does that mean as far as what kind of setups I should be looking for that make logical sense? What kind of orders should I be using for entries, etc.? And as long as you're maintaining that level head, because that'll ground you real quick thinking like that, even when you've lost 2, 3, 4, 5 in a row. What is up? What is it also doing? It's slowing you down a tad, making you think. Okay, that's a good thing. And then you're able to look at it and say, all right, I'm not making any blatant errors. I'm doing everything in my power. I'm taking good trades, and I'm not really ignoring anything I know I shouldn't be. What are you left with on the losing streak side? What conclusion are you left to come to? Statistical anomaly and, sure, market environment. But if you're doing everything you know you need to be doing, taking good trades, making sure they fit, etc., we're kind of left with more anomaly than anything, aren't we? If you have this entire video, I can sum up in one sentence. Or let's phrase it as a question. If I hand you a weighted coin, and it has, let's say, a 60% probability or a 65% probability. Let's just say 60 of landing on tails. And I say that because let's say we're in a range environment. Okay, let's say we're not in a trend environment. It has a 60% probability of landing on tails and a 40% probability of landing on heads. And I look at you dead in the eye and I say, hey, is it possible that this lands on heads 4 times in a row? It may not be the most probable outcome, but is it possible? And if you flip this thing 10,000 times, is it going to happen a lot of times? Of course, the answer is, well, duh. Yeah, if you flip that thing 1,000, 10,000 times, it's probably going to happen quite a few times. 3 in a row, 4 times in a row, yeah, sure. Even on the 40% side of heads. Why do you think about this any differently? It's the same thing. Keep doing your job. Maintain a level head. That's your superpower. That's what keeps your edge in place. It's what keeps you paid over a career. Maintain that level head. Keep doing your job and move on with your life. The streak will end. It always does. All right, guys. Hope that helps. I want to touch on with you guys here in the tomb dealing with, that's right, not losing streaks, dealing with winning streaks, because I think there is much to discuss. Man, just as much, if not more, which we'll continue to discuss here in the tomb with winning than losing. Now, I get it off the rip. This sounds very silly, okay, because winning is traditionally easy. Losing sucks. We like to win. But it brings up, there's certain complexities with winning that are not present as much, at least not in the same way, with losing. With losing, we all kind of know how we should handle it, right? You continue to do your job, and in certain market conditions, if you're not reading it well, you size down, and or if you're really not reading it well and maybe volatility is tremendously low or something, it's time to walk away, come back the next day. Well, I've often had questions also about winning streaks, and I think it's something that people don't really think about until it comes across their desk, so to speak, until they're in that boat where they've dealt with plenty of losing streaks, but now they're on a winning streak, and these psychological, I'll say this psychological trickery is coming up. And a lot of times what traders end up doing, I've seen this time and time again, they have their first kind of big winning streak. And it depends on your personality type, but for some traders, it leads to what I would call a dangerous level of confidence. Now, confidence in our trading is always a great thing. However, early in our careers, those first few winning streaks, it happens far too often that confidence goes unchecked. And what do traders start doing? And what, by the way, what kind of winning streak am I talking about? Let's say in the last 23 trades, they've lost 2 or 3 trades. Or maybe they've won, 14 in a row, which is going to happen to you, by the way, eventually. This is a long career, right? You're going to have losing streaks that go on longer than you think are reasonable. You're going to have winning streaks that go on maybe even longer than you think is reasonable. And you got to be careful, very careful, because if you're on that first time where you've won, 7 in a row, 14 in a row, you've taken 26 trades and you've only lost 2. A lot of times early on, you can get into this headspace where you just don't really, subconsciously, you don't really feel like you can lose. And you feel like you have a grasp on the market that is beyond the grasp that you actually have. Now, you may still have edge, right? And that edge might be very, very good. And you might be very good, or getting better at least, getting much better at retaining that edge and, leaving out the bad stuff, only taking the good. But when this winning streak comes, the same way that we discuss how when the losing streak comes, you need to understand that as long as you're following what gives you your positive expected value and you're not breaking rules, you're staying patient and you're staying disciplined. As long as all that is the case, you must understand that it is statistical variance and you need to just continue to do your job. With winning streaks, I really need you to understand exactly the same thing. Now, there's a little nuance here, right? If the market's in a huge trend, some of you may experience an increase in edge during that time, right? And those are the conditions where you might see a winning streak like this. So that comes into play. However, a ridiculous streak, like 17 winners in a row, is not necessarily probable, even in favorable market conditions, correct? So if you come across that, even smaller ones, like let's say you're on like a 7-trade win streak, right? Which of course will happen a bit more often, okay? The smaller the streak, the smaller the ask you make out of the variance, then the more probable, the more often it'll occur. When you're on one of these, even if it's a favorable market condition, you need to understand when it's kind of going beyond just a favorable market condition and potentially even a more positive expected value than is average for you. Right? And you gotta put into perspective that, okay, hey, this is variance and I'm loving it and it's great and it's tremendous. Just like how the losing streak variance is kind of sometimes tough to get through and it sucks, but hey, I can see the light kind of thing. With the winning streak variance, you got to keep a level head. Never let those highs get too low or the lows get too low. I'm sorry, never let the highs get too high or the lows get too low, right? So what I see traders do, they go on one of these statistical variance winning streaks and they start doing dumb things, the same way people start doing in losing streaks. So on the winning streak, maybe they start taking more trades. They start lowering their base quality of trades that they're taking in their personal accounts and their funded accounts. Now they start raising size. Now they're trading 4 times the size they would traditionally be trading, and they're putting on 4 times the size on a C- setup. When in a normal market environment, when their expected value is more average, we'll say, to whatever they might have in an average market environment, they might be trading 25% this size, and they're taking only B- and up. Now all of a sudden their confidence is unchecked, and they're taking 3, 4, 5 times the size, and they're putting on a D+ setup. You can see how this starts to go very poorly very quickly. Okay. Look, there's a lot of nuance to unpack with losing streaks and winning streaks. This right here, though, is one of the most important aspects. Okay, if I had to sum it up, and this gets easier as time goes on, by the way, as your sample size of trading days under your belt gets larger and larger, it becomes easier and easier to do not let the lows get too low and do not let the highs get too high. The same way that as traders, we would love to have as smooth of an equity curve as possible. It's not going to be perfect, right? But it's nice when it's smooth, isn't it? You want your emotional curve to be very similar, regardless of an average performance month or week or day, or a losing streak of varying degrees, or a winning streak of varying degrees. A winning streak can be just as dangerous of a statistical variance as a losing streak if you let it. Okay, take a step back and say, wow, this is great. I'm loving it. But I don't want to get too off my rocker thinking I, have some new feel for the market that didn't exist last week. Okay, granted, all of a sudden the market may be trending. Your edge might be better than it was last week. Okay, but is it ever really going to be so much better that rather than taking, let's say just for example, 5 contracts, whatever instrument, we'll just use 5 as a number. Is it ever going to get so good that instead of taking your typical 5 contracts, we'll say, of B- setups and up only in the fundeds or in your personal account or whatever, that now you're taking 30 contracts on a D setup? No, that's not going to be the case. A little bit of size variation, depending on what kind of streak or what kind of read you have on the market, is normal. Okay, and it's intelligent to do so. Sizing is very important. People get very carried away. They get very carried away, particularly in winning streaks. Okay, because that confidence goes a little unchecked. Man, let that confidence rock. It's very important for your trading. However, you need to make sure that that confidence is rooted in you following the methodology and doing the right things and being patient and disciplined. Okay, knowing you're retaining your edge to the best of your ability always. You don't want that confidence to be rooted in a one-off performance of a small sample size that has a large statistical variance baked into it, like a massive winning streak. Okay, be careful with this. Hope that helps. I feel compelled to issue a reminder and have a brief discussion with you guys here about a topic that I don't think gets thought about too much in the early days or even years of most traders' careers. And that is how important it is to, quote unquote, even out the curve of your emotions regardless of performance. Now, the reason I bring this up is because the chart that you're looking at is from a day, depending when you're watching this, doesn't matter. A lot of traders I know had tremendous days today. Now, again, whenever you're watching this, whether or not today was a great performance for you or not, maybe you're watching this on a not so great performance day, the following is still incredibly relevant. The good is going to come in every which combination, you're going to have a horrible day and then a tremendous day. You're going to have your best day ever and then an awful day. You're going to have 8 great days in a row, and then it'll just slow down but stay good. And you're going to have 4 horrible days in a row, and then it'll come back and get amazing again. And everywhere in between. Okay? The performance combinations are going to come at you from every angle throughout the entirety of your career. This is a long career, which is one of the great benefits of trading, right? You can effectively do it forever if you choose to. But since I know that today, the chart that you're looking at, had a higher than average number of traders who had a really, really good day, particularly from that push from bar 6 down to bar 11, and then that reversal from 14 up through 17. I want to touch on this a bit. Something that I see very, very often is newer traders, they come in and, this is natural, okay? When you have your biggest day thus far, or you just have a really good day, okay? Like you come in and you win 3, 4, 7 trades, and you lose 1 or 0. And you're looking at your P&L, and it's kind of in your upper range, if not a number you've never seen before. It's really easy early on to get carried away and bring an intensity level that maybe tomorrow's market environment does not deserve. Okay? It's easy to let the adrenaline get the best of you, not sleep very well that night. Even if you don't particularly notice it, maybe you're used to getting 7, 8 hours of sleep, and you get maybe 5 because you're excited, because you just had one of the best days you've ever had. You get up the next morning extra early, you come in, you sit down, underslept without realizing it. The market condition isn't exactly what it was the previous day. You come in guns blazing. All of a sudden, you've lost 3 in a row because you misread or ignored context. And you're not in such a great place mentally. Because you gave back everything you made yesterday, maybe. Or at least a lot of it. Or more than you made yesterday. And now you're in a spiral. Okay? This leads to big blowups. So what's going to happen to you down the road anyway, this is a natural occurrence as you get desensitized to bigger numbers. However, every time you get into your upper range, whatever that looks like at any point in your career, you are going to be presented with the sort of complicated thing to navigate, which is trying to maintain as level of a head as possible. Okay? You need to come into the market the day after a particularly good day, which again, I know a lot of traders had today, and just do your job like it's any other day. You cannot have an expectation necessarily, because looking at the chart, what is this not? It's not some massive, ridiculous trend that has a higher probability of continuing for the next day or two, is it? No, it was just a couple beautiful moves. If you had a great day, you had a great day. And tomorrow's just another day. It's an individual event. Which brings me to the next topic here. There is a time and place. We've touched on this in the past. If the market's trending hard in one very clear direction, that will oftentimes lead to some of your best days in your career. And it makes sense to maybe hit the sack a little earlier that night, get up a little earlier, come in, and put your head down for what is likely to be a long day if the market continues that move, which it sometimes will, and you want to be ready for it. But on a day like today, if that's not the case, meaning the market's not in some huge, massive trend, right, or volatility is just off the charts crazy and you're trading it really well, if it's more of like a normal-ish day, like today kind of was, and by the end of it, right, you need to take a step back. If you feel the need to, you should celebrate a tremendous day. If it was a record breaker, then go out to dinner. Do something. Recognize it so that you can put it behind you. Okay? We should celebrate our wins, even if it's just in the upper band of what you're used to, not necessarily a record breaker. Have a good time with it. Be proud of that. Go out to dinner. Do something you enjoy doing, whatever that may be. Ideally, not a destructive thing, right? Something that builds you. And then come home, or, finish up if it is at home, and say, okay, great. I can put that behind me now. I can go to bed, get good quality rest, get up, and face tomorrow's chart, and just do my job. Today is history. Okay, you do not. The last thing you want to do is carry an intensity that the market of tomorrow has yet to deserve into tomorrow. Has yet to earn, I should say, into tomorrow. If tomorrow's market earns that intensity, then hit it again, the same way you hit it today. But it has to earn it first. Don't let it carry over, because tomorrow's market is tomorrow's market. It could end up being a chart where it's slow and you've carried in an intensity because, yesterday happened to be a tremendous day, and now you give it all back, and that will put you in a dark spot. Okay, if you're stepping outside of your trading methodology to do that, which is what that would be. Now, to clarify, if it just so happens where you do your job and you do your job well and you happen to have a red day after a really good day, as long as everything fell into place, you took good trades, you didn't break rules, you were patient and disciplined, you should feel okay about it. Okay, but having a controlled, disciplined red day where you follow your rules, you don't break them, that's very different. You should be proud of those days. That's very different than coming in guns blazing, breaking rules, oversizing, taking C- trades when you told yourself you're only going to take B- and up in your funded accounts or personal accounts, and then you have a big red day. That is a very different feeling. That will destroy your confidence more than anything, because now you put yourself in a position where you're like, I'm not even sure if I can trust myself. And that's a weird place to be as a trader. Okay, guys? Again, celebrate the wins. Take a look at the market and say, is this an environment where I probably need to, a couple times a year, probably need to come in early tomorrow? No, not necessarily. It's kind of a normal market environment, at least in hindsight, right? By the end of the day. So I'll celebrate the big win. Put it behind me or you, whatever. Go to bed, get up, face tomorrow as an individual event. Just come on in, do my job. If the market earns intensity, then we'll bring it. Just like any other day, though. Don't go into it with a preconceived notion just because today was what was what it was. And by the way, the same thing here goes for particularly bad days as well. You want to even out that emotional curve. All right, hope that helps. All right, well, today was a monster bear trend day. Now, a whole bunch of people in our community here made a whole bunch of money today. And I want to talk about that just for a minute or two. Listen, the day's over now, okay? Huge day. RAM tends to perform well in most market conditions, assuming you have the context correct. But on days like today is really when RAM goes above and beyond and shines. Today was a monster day for a whole bunch of people trading RAM. It started off interesting. It started off as kind of, look, bar 1 through bar 15. Look at that. Turned into this. Okay, again, I just wanted to briefly touch on this because what will happen to a lot of people is they'll kind of start off the morning and they won't be doing so well, right? And they'll start to lose themselves psychologically, emotionally. Listen, guys, you have to be able to hang in there because this is really, really common when we get a big push that the day doesn't necessarily start off so obviously like, hey, this is going to be a big giant push. Sometimes it takes 5, 10, 15, 20, 25 bars for a trend to really develop. So I think it's important to, keep a level head, man. The day can turn into anything. You can go the other way too, where the first 12, 15, 20 bars of a day are massive, huge trends. And by bar 18, you're like, oh man, we're just getting started. And then the rest of the day is a sideways, tight, low volatility trading range. You have to stay on your toes. Listen, if today was the first kind of day that you've seen like this, or maybe one of the first that you really had your finger on the pulse of, these days happen. These are not once in a lifetime events. These are not once in a year like events. These days come, just not every week. Okay, but when they do, you got to be ready. Now, again, today is over. Whether you made a whole bunch of money today or you kind of missed the train, so to speak, it's over. It's in the rear view. 2 weeks from now, we're all going to just move on and be trading the days as they come. Today will be a memory. Let it go if you missed the train. If you did extraordinarily well today, let it go. It's in the past. Tomorrow is an independent event. It's a new day. Tomorrow could be a trend 3 times the size of this, or it could spend 80% of the day in a 22-point wide single bar trading range. We'll take the day as it comes. Okay, this goes for any day. I don't care when you're watching this. It's an independent event. So, if you did extraordinarily well today, I know a lot of you guys did, enjoy it tonight. Wake up tomorrow, ready to go with a new mindset that says, okay, today's an absolute independent event. I'll take it as it comes. The probability that we get yesterday is basically the same as any other day, right? We'll see. We'll see. We very well could also just get a tiny little trading range that doesn't really offer a lot. So I'm not going in with any kind of bias today. I'm just going in to do my job. Now, what mindset should you have if you missed the train today? Or maybe you lost today? If you're trading RAM, I don't know. You should have been able to recognize that trend, at least by bar 21, man. By bar 19, something should have been on your radar. But that's the beauty of this, okay? But listen, say, well, if you're telling yourself right now, you're like, I must just really suck then because I missed the whole train today, or I somehow lost money today. We've all been in that boat. Your mindset should be exactly the same mindset tomorrow morning as the person who went and had a record-breaking day today. We'll take the day as it comes. Yesterday's in the rear view. And we're showing up to do our job. Okay? These days are great. They're tremendous. Do not, regardless of your outcome, whether you were massive, massive green, whether you missed the boat, I don't know, you had meetings all day, you came back, you're like, are you kidding me? Or whether you somehow managed to be red today, the mindset is the same tomorrow morning for all of us. Okay? Hit that reset button. Again, enjoy it this evening. Enjoy your big green days, whatever. You should. You should enjoy it. Otherwise, why the hell are we doing this? Right? Enjoy. Celebrate. Go out to dinner. Do something. Watch a movie with your family, man. Enjoy yourself. Do something. Treat yourself, maybe, to something. Whatever. But tomorrow morning, we're all back in the same boat. Independent event. You've got to show up and do your job like every other day with no cockiness and no bias. Independent event, show up, suited up, ready to go, ready to do your job, just like any other day, man. Listen, I really have a message that I'd like to share with you guys that I think a few of you may need desperately, maybe not desperately, but at least may need to hear right now. Last week, context time, no matter when you're watching this, we had a very high volatility week. Today happens to be a Tuesday. Yesterday and today, so Monday and then today, Tuesday. Volatility has been about a third of what it was late last week, just for context. When that happens, when volatility tanks, it's really common for people to need a day or two, sometimes 3, to adjust. And those days, it's very, very common, especially in the earlier years, to have not so great days. Okay, now when I say not so great, I don't necessarily mean a controlled red day. I mean it's really common to have a bigger red day. Kind of a blow-up red day. Now, listen, I need to share something with you that I wish somebody had shared with me as often as I will be sharing these thoughts with you guys in my early years. So here it is. Today means absolutely nothing. Do you understand? You guys, when I look back at red days throughout my career, I genuinely do not even remember 98% of them. Probably more like 99% of them. I don't remember at all. And I know that I felt the way that you're feeling on most, at least many, of those 99% that I do not remember. Guys, I will have a red day. Think about it 2 weeks later, and I cannot even tell you what day it was, how much I lost. I don't care. Okay? When you start trading consistently, and you're making consistent decisions, and you're stress-free while you're at your battle station because you know and you have confidence in the methodology or the strategy, and you've seen results produce themselves over and over and over, the red days are not meaningful. Okay, excuse the cliche. This is a marathon. This is not a sprint. It feels like a sprint, let me tell you. When you're trading each day, man, it feels like a sprint. You're looking at, bar 18. You know, is bar 29 going to do something? No, it closed right on that wick high. Right? Today was kind of a slow day. In hindsight, it's kind of hard to see that. But you look at the ATR throughout the day, it's a 5-minute chart on NQ. It was about a third of what we were seeing, what we were kind of used to seeing last Wednesday, Thursday, Friday. Again, today's a Tuesday. Yesterday was the same way as far as low volatility, comparatively speaking. Again, really common for traders to have adjustment periods when things change this drastically. Whether or not you're red today or green today, maybe you're revisiting this tomb talk while you're going through a losing streak. I need you to internalize something. Do not think, how did I perform today? What you need to think after every trading day, if you want to win and win consistently and make this a full-time gig or at least a hefty part-time gig, but I mean, come on, brother, let's go big. Right? The goal is to be a trader, right? Let's be traders. If that's the goal, man, you need to think unlike the masses. The masses think, how did I do today? Oh, look, I was green today. Okay, talk to me in 3 months. They look back on the last 3 months, they're hemorrhaging money because they're not making consistent decisions. They don't have positive expected value. They have no edge. Traders with edge look back on a red day and they say, okay, what could I do differently? I think I made all the best decisions I could have given today. Interesting. Wow, interesting. It didn't work. All right, let's go ahead to tomorrow. Let's go to dinner. This is not tongue-in-cheek, guys. This is how profitable and consistent, even just relatively consistent, traders think. This is not complicated. It's very simple to think that way once you have consistent results. And before you have consistent results, you have to force your hand a little bit, okay? Now, how do you get that confidence to think that way before you have the track record to, kind of prove to yourself that you can think that way? Give yourself permission to think that way. Well, continue to make consistent decisions. Keep things simple. Trade a single methodology. If you're trading RAM, do your best to trade RAM to the best of your ability every day. Do not break rules. Do not move stop losses. Do not take winners before your intended target if you do not have a reason to do so. Okay, within the RAM framework. Do not get bored. It's okay to get bored. It's fine. But do not sit there and lose patience, I should say, and take a trade that you know is not there. When you don't do those things, guess what happens? All of a sudden, your self-respect, regardless of P&L, it goes through the roof. And when your self-respect goes through the roof, the importance of red or green day takes a back seat. Believe me, it really does. Because you respect what you're doing at the battle station. You understand? And you look back in a couple of weeks and you're like, wow. Wow, my performance has impressed myself. I get it. This is an emotional game. You're like, well, Nico, big dog, I got bills to pay. Yeah, well, right back at you, big man. Market doesn't care. Market does not care that you have bills to pay. Market doesn't even know you exist. Market's not human. Okay? The market is here for buyers and sellers to meet up. All we're doing is playing human psychology, self-fulfilling prophecies that present themselves in the form of context and price action, with the singular goal of developing a positive expected value through having statistical edge given a big enough sample size. The law of large numbers. That is our job. Do not overcomplicate our job, okay? When you're bored, it means nothing. Nothing at all to anything that we're doing. Okay? It's okay. It's okay. If you want to put on an interesting podcast on the side about physics, like me, or space, man, keep it quiet. Don't let it distract you, but it'll keep you occupied. Listen, we are human. If you sit at the screen when the market is in a trading range and it's bar 69 and it's done nothing for the last however many bars and you haven't taken a trade in hours, what are you going to do? Feel sorry for yourself? Oh, I'm going to start trading. Okay, be like everybody else, because everyone else traded from 55 all the way to bar 68. And their accounts are blown. But at least you were entertained, right? Wrong. It's okay to get bored, but don't lose patience to the point of doing things that are outside of the goal. Okay? And when you execute to the best of your ability and you finish the day, do not, I'm telling you, I'm very serious, do not get your self-worth from your P&L. You are a person. That is a disgusting way to look at yourself. You understand me? Don't do it. I did it for a long time, and I'm telling you right now, it is not worth it. It is not worth it. Get your self-respect and your self-worth from, did I do the right thing when I was supposed to do it? And did I do nothing when I was not supposed to do anything based on what I've already told myself I'm going to do? If the answer is yes, 100%, you killed it. You killed it today. You'll say, yeah, but Nico, I'm red. I don't care. I don't care. You went out there, you murdered it today. You did your job. It just didn't pay you today. But guess what? With positive expected value, give it a few weeks. It'll pay you big time. You start scaling that thing, it'll keep paying you big time. Law of large numbers. Statistical edge over a big sample size equals positive expected value. Okay, equals making money. All right? Listen, if you needed to hear it, think about that. Okay, this is coming. I don't know if you can tell, but this is coming from a whole lot of hell that I personally went through. No one told me any of this. I had to think about it myself. Come to these conclusions myself. Go through the hell myself and come out the other side barely breathing, bleeding, half alive, and look back and say, wow, that was really, really tough. But I barely made it. Okay, take it from me. It's not worth it. Do not get your self-worth from your P&L. Do the right thing when you know you're supposed to do it. If you do that, whether you're green, break even, or red, say, you know what? I killed it today. Killed it. I did my job. Go enjoy your evening. Come back tomorrow. Back to work. Look back in a couple of weeks, and you'll be shocked at how much of a monster you are. All right, guys. Have a good night. Question, ATR was 32, and I went long on the close of bar 5, putting my stop just under the signal bar. After I entered, it turned around on me for a stop out. In retrospect, did I miss that 5 was shrinking? Let's zoom in here and take a look at bar 5. I know exactly the bar that you're talking about here. So if you put this to the side, okay, listen, yes, bar 5 is shrinking, which downgrades that setup from an A or an A minus, considering the size of 4, to a B. Okay, straight up. That's no longer an A setup. That's like a B plus setup. B plus, okay, because look at that push. Beautiful, but the bar is shrinking, so that's more like a B plus. If you really wanted to stretch, maybe an A minus, but at that point, we're splitting hairs. That's like an A minus, B plus kind of setup, right? Good setup. Put it on, risk the signal bar 5, keep risk relatively small from your entry to your risk point. You're talking, maybe 30 points. That's not too bad. In a push like this, that's not too bad at all. Just size yourself appropriately. In this case, put you in the money quickly and turn around and stop you out. Good trade, just didn't work here on bar 5. That's okay. It's part of the game here. You don't need every trade to work. A small edge can pay you all the money you could ever want or need. Look at Vegas. Right? Good trade, just didn't work. We have a question here. Someone would like me to review their trade. Okay, they said, Nico, I took bar 12 for continuation today. I considered it an A setup. Is this a case of it just not working out, or did I miss something? I sized up on it because I graded it in A setup, so it stung a little bit extra when it failed. Okay, let's take a look. So, now, my first question would be, when they say they took bar 12, I assume they mean the close of 12 into the open of 13, because that one failed. But for the rest of you guys watching, 10, also a very reasonable setup. That one tremendously worked out. 11, another very reasonable setup. That one pulled in, didn't take out the wick low of 11, also worked out. 12, another great setup. That one happened to just not play out. Okay, so again, I'm going to go ahead and assume with great confidence that they meant, or they mean, I should say, as they stated, they took the close of 12 into the open of 13. Okay, look at this setup. You have 10, 11, 12. That's a 1, 2, 3. You have 11 and 12 growing in comparison to 10. The close of bar 12, is it just quite as clean as the close of 11? No, there's a little extra wick. But that's getting extraordinarily picky. Would I love if 12 closed with no wick at all up top and improved on 11, or at least matched 11 as far as cleanliness on the close? Of course I would. Of course I would. But that is very, very picky. To me, when I look at 10, 11, 12, and you guys know I'm picky, okay, but that's getting a little crazy. When I look at 10, 11, 12, I look at the range of 12 compared to the ATR, compared to 10 and 11. Would I consider that an A setup, the same as our friend who asked the question here? I certainly would. I certainly would. The same way that I would consider the close of 11 an A setup. The close of 10, maybe a B plus A minus type setup. Okay? But the close of 11 and the close of 12, which is the trade that our friend took, yes, sir, I would grade that an A setup. I'd have to. I'd have to. And you know what? Sometimes, welcome to trading, A setups don't work. Ooh. But you need to understand that that reversal there is the lower probability event if you had that exact same setup right here, 1,000 times. That is not going to happen quite as often as a continued push, or at least attempt of a push higher. Okay, that's just probability. But even if you have a weighted coin that's, let's say, 65-35 or 70-30, sometimes you're going to land on the lower probability side, are you not? Just because a trade ends up being a loser does not mean that it didn't have statistical edge, aka positive expected value. This is one of the most important lessons that I need you guys to carry through your career, and learn it ASAP if you have not yet. Just because a trade was a loser doesn't mean that taking it wasn't the right thing to do. The same way, by the way, that just because a trade was a winner doesn't mean that taking it was the right thing to do. Okay? This is extraordinarily important. You have to understand this in trading. Crucial. Crucial. What a push, though, on this chart through, 8, 9, 10, and then 10, 11, 12. Beautiful push. Multiple setups there, 10, 11, and 12. All reasonable trade setups according to RAM. Beautiful setup on 12, but 12 happened to not work out, and that's the one that our friend here happened to take. And you know what? That's okay. That's okay. You're going to have a lot of losing trades over your career, but you know what? As long as you carry your statistical edge through your career on average, mathematically, you'll come out the other side and have done very well. Okay, the key is always keeping your eye on that dull object, which is the statistical edge, positive expected value, also known as, by the way, following your methodology, being disciplined, being patient, taking the trades that you know you're supposed to take when you're supposed to take them, regardless of how you feel, and not taking the trades that you know you're not supposed to be taking, regardless of how you feel. Boredom, right? Fear versus boredom. Both of those are irrelevant when it comes to maintaining your expected value on the side that it needs to be, which is positive. All right, hope that helps. Question. I went long on the rollover of bar 4 into bar 5. Okay, so they bought the close of bar 4 here into the open, of course, of bar 5. Size down, good. That's about a 70, what are we looking at? 75, 80-point bar, 76-ish points on the range of bar 4. Good, size down. And got stopped out. Yes, this one reversed, stopped you out beneath the wick low of 4. Okay, I hesitated due to the size of the signal bar and the unsightly look of bar 3, but I decided that the rest of the push higher was too good to not participate. Good setup, or do I have some tunnel vision and seeing what I want to see? So my only question on bar 4 would be, how quickly did you get a fill, and did you use a limit buy or a stop limit buy? If you size down, put a stop limit buy as close to the wick high of bar 4 as you could as bar 4 closed and bar 5 opened. Because you wait for bar 4 to close, place a stop limit buy as close to the wick high as you can get, and then give it about 20-25 seconds to see if you can get a fill, since bar 3 is a little bit ugly, yes. Then you did everything in your power. You sized down, you used a stop limit buy to enter, not a limit order on the rollover. You used a stop limit buy right above the wick high of 4 to enter on the size down position sizing, and you gave it only 20 to 25 seconds to fill you, and it did, then that was a good setup. It just didn't work. But if any of those 3 things were not true, you didn't size down, you used a limit order or a market buy as soon as it closed, or, you gave it, let's say, 2.5 minutes or 55 seconds or anything more than 20 to 25 to give you a fill on the stop limit buy, then it was not a good trade. Okay? If it filled you, within that if it doesn't fill you within the 20-25 seconds, because again, it doesn't deserve 30 because 3 is ugly. So you give it 20 to 25 because it's a quality setup. It's just not A or A+. Okay, so you split the difference, 20-25 seconds to get a fill. All right, if it doesn't fill you in those, you got to pull the order, cancel it, move on. No fill, no trade, right? But again, hey, you size down. You use a stop limit buy above the wick high of 4 on the close, and you only gave it 20 to 25 seconds to give you a fill, then it was a good trade. It just happened to not work, which is okay. That's part of this business. But if you broke any of those 3 rules, I'd say next time, you got to skip that. The importance of not booking up early. Why is it so crucial to squeeze the juice out? Now, this is, I gotta tell you guys, this is like one of the biggest issues I see plaguing the trading space, and very few people even realize this is a problem because booking up profits does not seem like an issue, right? It always feels like a good thing. One of the most common phrases in the trading space is, green is green. You should always take green. No one ever went broke taking profits. Well, that's not correct, actually. I've seen a lot of traders go broke taking profits because they're taking profits early and they're not paying for their losses, right? So here's the math behind this, okay? And by the way, I don't mean if you intend for it to be a scalp, you pull it at, let's say, a half ATR target. That was your intention. That's not early. What is early? Well, let's say ATR, which is the average range of a 5-minute bar in this case, because this is a 5-minute NQ chart. 23.8, bottom right of your screen. That's what it happened to be here on bar 78. Let's say you were like, okay, my target is a full ATR, which would be 23, maybe 24 points, for example, on bar 78, right? Which, again, beside the point, but it's right before the New York close. You probably wouldn't be in a trade at that time, most likely, but whatever. For example, and it goes 7 points in the money. Your target's 23, 24 points. You're 7 points in the money. And oh, whoops, things have slowed down. They've gone sideways for 3 minutes. You're screaming internally. You're having a heart attack, etc. So you find something conveniently, don't you, on the chart where you're like, I didn't see that before. I should book this up. You really need to take an internal look at yourself and understand that the reason you're doing this is not because you every time happen to see something new on the chart, is it? The reason you're doing this is because you're scared it's going to turn around and turn into a loser, correct? I get it. But here's the math. In order to maintain your edge, your positive expected value, which is the only way you could ever have a career at this, is by maintaining that on average, is by squeezing the juice out of the quote-unquote good trades. The trades that work well, oftentimes the trades that work quickly. Now, if you're taking profits early on trades that work quickly, we got bigger problems. But on the ones that are kind of meandering, and maybe you're managing bar by bar, maybe you're not, but if you are, it's taking its time. It's not going as quickly as you'd like. We've all been there, right? Happens to me all the time. Be sitting in a trade for, 45 minutes. Where on that style of trade, my average might be 10 or less. And my eyes are glazed over. I'm bored out of my skull. And I'm like, oh, could this market just do something? And most traders in that moment, they find a reason to get flat. They find a reason to book it up. If you're long and you do not have a reason to sell and it has not hit your take profit or your stop loss, and when I say reason to sell, I mean you have not had a reason to cut it early based on your bar-by-bar management within RAM, right? Then why are you cutting it? Because you're, a 45-year veteran trader and you've seen what you're looking at 30,000 times? Is that why? No, that's not why. You're taking it because you're scared. Which means a few things. First of all, you might be trading too big. Straight up. And I know you don't want to hear it because trading smaller isn't fun. It's a hit to the ego. I get it. But if you're horrified and breaking rules and doing things that you know deep down are not congruent with your goal of doing this full time, and you're doing those things because you're nervous, well, we have a sizing problem, don't we? I want you to think about something for a second. If you took a trade and you put on 1 micro, do you care really at all? Not really. You put the trade on and you're like, all right, what do I do? What do I do until this thing plays out? You're looking at it. You're in the red. You're in the green. You feel basically nothing. That's how you want to feel. Maybe a point or two on a scale of 1 to 10 higher than 1. You're at a 2, 3, maybe a 4. Emotionally, a lot of you guys live your life in front of the charts at an 8 or higher. First of all, that's not an enjoyable existence. Even if you are making money, you're not going to enjoy that for very long. I've got news for you, dude. You're like, don't care. Give me my money now. Yeah, well, I'll tell you what, you're making it a lot harder for yourself to even get that money, and you're living at an 8 or above. Wouldn't it be nice to make way more money, far more consistently, and live at like a 3 or 4 or lower emotionally? Wouldn't it be nice? Okay, so stop guessing, maybe, oh man, there's a resistance level here from 3 weeks ago. I didn't know it was there. No, you knew it was there had you looked. You just didn't care because you're trading price action. But now you care because you're nervous it's going to turn into a loser and it's not working as quickly as you'd like. Stop lying to yourself. This is a problem. Okay? When a trade is working and you have no reason to get flat based on the bar-by-bar management or the orders you have put out, then do nothing is most of the time the answer, right? That's the default. Again, unless, what's the exception when I say most of the time? Unless you have a bar-by-bar management reason to get flat. Guys, my best trades tend, and your best trades most likely, they tend to work quickly. But I'll tell you what, there's a whole bunch of really good trades for me that take their time. And that's okay, by the way. Okay, these are emotional mishaps. And when a trade is working, here's the point. When a trade is working, you need to be able to squeeze that existing edge that's on the table out of that trade. Because listen to me, you know how we always talk about every trade is a mathematical equation, it's a sliding scale, it's a spectrum. This is a concept most traders cannot grasp. Listen to me carefully. It's a sliding scale, the math is always changing, and it's always a fog. You're never quite sure because there's no math equation on your monitor that's like, hey, here's the probability to the exact T on this trade, and it changes as you know, it goes tick by tick. And here's your reward to risk on this exact trade, and it changes tick by tick. That one you might have a little bit more certainty, but without probability, again, it takes reward to risk and probability to determine what the edge is. It's never set in stone. It's always in a fog because that's how the market operates. And that's our job as traders, to navigate the fog. You staying with me? When a trade is going against you, ideally, your stop is in a position where, based on the trade that you took and your plan in the trade, how you sized yourself, how long you expect it approximately to take, is this a scalp or a big old intraday swing? Your stop should be in the most clear spot where, when it breaks that area, you're no longer confident that you have edge on the trade. Those 2 points should meet. Your stop placement is basically at the place where, when it breaks it, you're no longer confident enough to leave it on that you have edge on the trade, which is why I'm very often using the signal bar on continuation trades, the most common curl, the most obvious recent curl, right, on bigger intraday swing type continuation stuff or limit order reversion scalps, right? Because if it breaks that, that's where my confidence is saying, yeah, in the fog, I'm no longer confident enough to leave this on, that I have edge, so I cut it. Okay, so that theoretical edge in my head, in your head, as a trade goes against you, gets lower and lower and lower until, boom, it goes over that edge as you get stopped out. Or if you have to have a bar-by-bar management incident, right, or opportunity to manage early, which I do see as an opportunity. It's a good thing. Now, as a trade is going in your favor, what's happening to that theoretical edge in your brain? It's maintaining, if not maybe improving. I'm talking edge. Okay, not reward to risk. I know some people might misunderstand what I'm saying here. They'd say, well, isn't reward to risk better as it goes against you? And isn't probability increasing as it goes in your favor? Yeah, it's a sliding scale. But on those winning trades, listen so carefully, please, guys. I'm begging you, because this is what I didn't understand getting started. And this is what 99, I'm not even exaggerating, I wish I was, like 99% of traders, they do not even think about this. As the trade is going in your favor, those are the trades you need to squeeze the juice out of. So when after 30, 50, 100, 1,000 trades down the line, you look back on, you squeezed the juice out of those extra plump oranges, right? Whatever. And it made the math work. It took you from being a losing trader or a break-even trader into the green. which is what is the difference between going back or maintaining your job that you do not like and you're trying to get away from, that's why you're here, or you see something better on the other side. It's the difference between what keeps that something better, being a trader, out of reach, or your actual day-to-day reality and leaving the job in the past or cutting back on hours, whatever your goal might be. There are quite a few traders out there. This is the difference, and they will never know it because they don't look at themselves in the mirror and they just think, hey, green is green. I should always take green. Nobody ever went broke taking profits. Yes, they have. Dreams have died taking profits early. What is early? When I heard this getting started, well, I didn't hear it as often as, the green is green garbage, which is what it is. It's garbage. But when I heard this getting started, like, you got to let your profits run, right? What a vague statement. Cut your losers early, let your profits run. What does that mean? I don't know what that means. That doesn't mean anything. It's hype talk. It's garbage. It doesn't help us. Early is before your plan initially intended without a honest bar-by-bar reason to do so. That's early. If you enter a trade and you're like, I'm going to take this as a regular day trade, I'm targeting a full ATR. That's what you tell yourself. Let's say a full ATR is 52 points and you take it off after 17 or 37 or even 41 because you're nervous or scared. That's early. You're like, well, Nico, it's really hard to stop doing that. How do I stop doing that? You trade smaller and or brute force discipline. If you cannot do one or both of those things, ideally both is going to give you the strongest foundation, then you must not want this very much. All right, guys. Let me know if you want me to expand more on this. Hope that helps. Question. They say a couple days ago they took 2 trades that were winners and they ended up making about 40 points. And then yesterday they took another 2 trades, both losers, and they lost 60 points on those 2 trades. They said so their losing days are ending up larger than their winning days. That imbalance is messing with their psychology. In order to try to fix that, they're thinking about changing their stops to an ATR rather than the signal bar or whatever makes sense in the trading range if they're trading a trading range method. Okay, hang on. There's more to this question, but I need to stop right there and put out some thoughts. We're talking about, first of all, we can't go and say, oh, my losing days are ending up bigger than my winning days. These are 2 days. The sample size here is nothing. Okay, but even if that were to end up being the case, if you only took 2 trades that day, still we have a sample size issue. All right, now had you taken, 3, 4, 5, 6, 7 trades a day, you've had 50 winning days, 50 losing days, and your winning days are 10,000 and your losing days are 25,000. Something's up. There's a problem here. Okay, but to say on Monday, I made 40 points. On Tuesday, I lost 60 points. This is a sample size error. We're talking about 2 days and 4 total trades. We cannot make conclusions based on 4 trades. Okay, that's not a good way to look at the statistics. Secondly, as far as risk management, I would not go adjusting my stop to just a full ATR to try to mitigate what you're scared of right now, which is having a losing day being larger than a winning day. Okay? Listen, for me, with RAM, I gotta risk what needs to be put at risk. If it's a continuation trade, I'm risking the signal bar. If it's a range scalp, I'm risking what makes sense to risk. So if I'm buying a bear close in the lower third of a soft bull channel, if I can make sense of a wick low, the previous wick low on the previous bounce, that's what I'm going to use to manage risk. I'm not going to tighten that up because I'm scared of losing money. The answer to this question thus far, and there is more to this question, we're going to get into it. Listen, guys, the answer to this question is not Should I adjust my stop to an arbitrary amount? No, the answer here is you need to trade smaller. You're not psychologically handling well taking a couple of losing trades. Okay? Listen, it's going to happen over 4 trades. You win 2, you lose 2, you make a bunch of money still. It's also going to happen. You win 2, you lose 2, you end up in the red because it just so happened that the ATR, in this case, if you're shooting for 1 ATR target, happened to be less than the risk that was necessary to put on in those trades. Okay? That is not always the case. It depends on the trade. Now, listen, within RAM, it's totally okay if a signal bar is a little bit, or even a little bit more than a little bit, than a 1 ATR target, as long as what is in check. Do you know the answer to this question? If it's a negative reward to risk trade, what needs to be in check? Probability. The math doesn't look better or worse, it's just different. A whole bunch of beginner traders will never take any trade that's less than like a 3-to-1 reward to risk ratio, because that's what they saw on YouTube. That's ridiculous. That's absolutely ridiculous. Can 3-to-1 work? Of course. But it's one of many. That's like saying the only vegetable I'm ever going to eat is green beans, because everything else doesn't work. There's a lot of good vegetables. You know what I mean? Oh, the only protein I'm ever going to eat is a chicken breast. Because seafood, not for me. You know, lean red meat, nope. Oh, turkey breast doesn't work. The protein just doesn't work. How ridiculous. This is what gets spewed. 3-to-1 can work if the probability is in check. Guess what can also work? 1-to-3. Okay, now in RAM, it's usually a little closer to 1-to-1, give or take, just based on the way that the setup presents itself. And it's going to be a case-by-case basis. Okay, but again, I will repeat myself. You will have 4 trade sample sizes where you win 2, lose 2, and you lose money. You'll also have 4 trade sample sizes where you win 2, lose 2, you're break even. You will also have 4 trade sample sizes where you win 2, lose 2, and you're up a whole bunch of money. Every trade is going to be a little bit different, but they tend to rhyme, especially if you're trading proper setups under the umbrella of range versus trend context, which is where RAM always starts. Okay. All right. Still part of the question here. They go on to say, one more thing that I'm wondering. Would it make sense for me to implement a daily max loss rule? For example, if I lose $250 in a day, I stop trading completely. I feel like this might help protect my psychology and keep one bad day from wiping out multiple good days, but I'd like your opinion. So, yeah, I have some thoughts on that. In the early days, having a daily max loss limit makes a whole lot of sense. This also makes sense if you know yourself and know that you tend to spiral if you lose 2 or 3 plus trades in a row. Which, of course, that's going to happen. Of course you're going to lose 2 or 3 trades in a row, or even more someday. Guys, take a weighted coin, not that you have one laying around, but an imaginary weighted coin, and flip that thing. Are you going to land on the I'll call it the less weighted side, the unrigged side, 2 or 3 times in a row, eventually, or more? Of course you are. Trading is only a game of statistical edge, positive expected value over a medium to large sample size. Those numbers have a higher certainty of working out the bigger the sample size gets, and by working out, that means producing a predictable profit. But you have to have edge to begin with. Okay, assuming you do, sample size is important. A sample size of 2, 3, 4, 5 trades is absolutely nothing. It's totally possible to take positive expected value trades and lose 5 trades in a row. Hell, 10 trades in a row. It's going to happen if you trade long enough. Guess what's also going to happen? You win 18 in a row. And you're like, I cannot be beat. It's a statistical anomaly. The more outside of the norm the streak gets to the losing or winning side, the more of an anomaly it is. Okay, now, when you have trouble grounding yourself in that reality and you lose 2 or 3 trades in a row, what a lot of people do is they spiral. If that is you, which is going to be most traders, then yeah, having a daily max loss limit makes sense. But here's what I would encourage you to do in addition to that. Have a daily max loss limit, but trade smaller per account in the meantime. If you lose 2 trades and you're off your rocker upset, you're trading too big. Do you understand? I'm not trying to convince you to trade smaller so you make less money. Why would I want that? I want you, if necessary, to trade smaller so that you maintain a level head and you make more money. Not even in the long term, just like in the near term. Okay, the number one issue across this entire industry, once you get past people like not knowing what a candlestick is and all this, the number one issue is people's egos are too big. They refuse to size down. I still see it. Daily. People in a 50K account, they're like, I'm trading kind of small. I'm trading 4 minis. This is a 50K funded account with a prop firm, for example. Let's say it has a $2,500 trailing drawdown. They're trading 4 minis when the ATR is 60, and they think that that's small. That's an ego problem. Of course you're going to blow that account. You don't even have to lose many trades in a row to blow that account. Right? I mean, you take 1 trade, you lose, let's say, 50 points. Oh, goodness. The account was blown, 15 points ago. It was crazy. Crazy. We need to size down. If you lose 1 trade, you're off your rocker, you're trading too big. Assuming you're following your own plan to begin with. That's a baseline assumption here. If you lose 2 in a row and you lose your mind, you're trading too big. How do you fix that? You size down. Don't tell yourself, oh, great, now I'm not going to make any money. No. This is how you get to making money. Is you size down so you don't really care when you lose or when you win. This is going to sound contradictory, but listen to what I'm about to say. The people who care the most about the outcome of any single trade make the least amount of money. That is the reality here. Question, is risk strictly defined per trade, or should I also enforce a daily loss limit? Okay, so daily loss limits, we've talked about this a couple of times in the past here. I think that they have their place. Now, you have to understand the difference between having their place in the human psychology and emotional world versus do they have a place in the world that really we live in or we're trying to always exist in, which is the world of having statistical edge, but we also are human, okay? So we kind of have to have 1 foot in each world at each time, at the same time, I suppose. So, listen, hear me out. Daily loss limits, realistically, if we could remove all human emotion and human psychology, they don't really make a ton of sense. And let me explain why. Some of you guys are like, what are you talking about? Let me explain why. If we could just be robots and trade the methodology sitting here at the screen, and you wait through periods, of negative expected value, you wait through lulls when there's really not much to trade, and then you hit stuff when you believe your edge has presented itself. Well, then, to be honest, what your P&L is at any given time doesn't matter. Okay, because it's just variance. It's just statistical variance. Does the casino stop dealing you hands of blackjack just because you've won 6 hands in a row. No. As long as you're playing within the rules and they do not have reason to believe that you're cheating, they will continue to deal you cards. Okay? Now, the difference with the casino and us is the casino knows as long as the player is within the rules and not cheating, the casino has the edge. It's easy for them to know that, reasonably. For us, it's not quite as straightforward, okay? But if, again, in robot world, if you had reason to believe that you're wading through periods where you do not have positive expected value, and you have reason to believe that all the trades that you're putting on are positive expected value trades, it just so happens that you've lost a few in a row, then yes, in perfect robot world, you should technically, mathematically, this is not something you can argue, by the way, just mathematically, you should keep trading if you believe you have edge. Now, in human world, in real world, here's the problem. As that red P&L gets bigger and bigger and bigger, most people are going to have some kind of adverse emotional reaction to that. And what happens when that occurs? Decision-making can sometimes go out the window, which now takes what would be positive expected value and can flip it into negative expected value. And you're telling yourself that you still have positive expected value, but in all reality, the expected value is now negative, and you're lying to yourself because you're emotional, because we're a human, right? And that does happen sometimes. It starts to happen less often the longer you're at this, which is kind of the advantage of staying in the game longer. But you got to keep an eye on that, man, especially in the early years. It's really important to keep an eye on that. As you get more emotional, you will start lying to yourself more. Facts, right? So, in the real world, here's my answer to the question. Should we also enforce a daily loss limit? Here's my answer. I think if you have, and this is where it really helps to be able to look at yourself in the mirror and say, straight up, here's the truth. If you know that you often have issues with emotion, when you lose, 2 or 3 trades in a row, and basically every time, with the exception of the one lucky day where you dig out by gambling, basically every single time you make it twice or 3 times or worse as bad, well, then a daily loss limit's going to make a lot of sense. What do you set it at? A dollar amount, I don't know. I don't know if I'd set it at a dollar amount. Maybe you would set it as if you lose like 3 trades in a row. Something I've used on people in the past that actually worked pretty well was if you go down 3R from your high of day P&L, stop. It's a trailing max loss limit. So if you never win a trade and you lose the first 3 trades in a row, that's 3R, and you stop. If you go up 6R and then you come back down and your P&L is now 3R, you stop. Okay, I've used that in the past with people, but you got to be really careful. I do not believe in choking your trading. I don't believe in that. A lot of people, they'll say, if they lose their first 1 or 2 trades of the day, it's time to cut it. Listen, guys, some of my best days, I lost the first 1 or 2 trades. And then the market decided to trend the last 4 hours of the day. And it's like I couldn't lose. Just because the market was playing very nice with a big, aggressive trend. And it was ram continuation after ram continuation. Okay, and I wouldn't have had those days if I was choking my trading. I don't believe in choking your trading, but I do believe in just having a protective backstop if you know that you sometimes have some issue with emotion. That doesn't make you weak, by the way. It just makes you human. Okay. Or B, I should say, or case B, you tend to start making worse decisions, not necessarily so consciously emotionally driven, but you begin making worse decisions as that P&L starts to backslide, and it becomes like a self-fulfilling prophecy of its own, where it starts to just, you're taking trades more often with worse expected value, and you're doing it faster and with more size. All of a sudden it becomes this kind of self-sabotage, like self-fulfilling prophecy sort of thing, which starts as it goes on to turn into just an emotional issue again. Okay, so listen, if you want to, I gave you some examples. Again, I've used those on people in the past to deal with these problems until they grow out of them, which if you can stay in the game long enough, you will grow out of it. I don't think you're ever going to grow entirely out of this, by the way. You know, we are all still human, and it's not fun to face statistical variance, you know? It's not a good time. But you're going to have less issues with it the 17th or 170th time that you face something than the first, second, or third. Okay, that is getting desensitized, which is like one of the most important pillars, I would say, inside of RAM that isn't even really part of the strategy, is getting desensitized. What does that mean? It means continuing to scale responsibly, okay, but efficiently, and getting your screen time in. That'll all desensitize you and make you a better trader by default. Okay, so again, I don't believe in choking out your trading with really tight daily max loss limits. That does not work in my experience. I've tried it with myself. I've seen others try it with themselves. I've never once had it be like the end-all be-all, oh wow, yes, this is the way. But I have used slightly looser limits with people and myself with some success, more so just backstopping emotional mishaps and really catastrophic misreads of context, okay? But I do not believe in choking out your trading because of what I said about, again, some of my best days have come from mornings where the market, it kind of went one way, reversed, went the other way, reversed, went the other way. I lost 1, 2, maybe 3 trades in a row. And all of a sudden the market goes into a big trend, turns into one of my best days ever. You'd miss those if you're choking yourself out. Okay, hope that helps. Okay, part 2 here to the daily max loss limit question. They say, if they do decide to set one that is not so constricting. Okay, because you guys know, again, I don't believe in choking yourself out with a super ultra tight daily max loss limit. The purpose is to save yourself from absolutely catastrophic days where you get so emotional that you can't stop yourself, or B, you are just having a catastrophic, fatal misread of context. Okay, it's really meant to save you from those days, not just basic drawdown. If they do set one of those and they hit it, should they still take a really high quality setup if they see one? Okay, listen, since it's meant to stop you from emotional mishaps and catastrophic days, I think if you do set one that doesn't choke you out, very important, again, I do not believe in choking out your trading with really tight daily max loss limits, but it makes sense to have that ultimate backstop, especially if you have emotional issues. If you do set it and hit it, I don't care what you see, it's time to walk away. It's there for a reason. And to be fair, when you're in that scenario where the daily max loss limit is there to protect you from, when you're in that scenario, you will tell yourself things that aren't necessarily there. You are emotionally fueled at that point. So you might see a setup where when you're, in a normal mental state, you'll be like, yeah, I don't know, it's like a B minus setup. And all of a sudden, your emotional brain, your lizard brain is telling you that's an A setup. And you're believing it. It's time to go get some rest, get a fresh set of eyes, get away from the screen if you do hit that not too tight daily max loss limit if you decide to set one, just again, to save yourself from catastrophic days. Now I'm talking, in my examples in part 1, a 3R trailing max loss or a 3R in general max loss, daily max loss limit. For some traders, that can almost be kind of tight, 4 or 5R, maybe 6R. That's still going to do the job of protecting you from catastrophic days, because days that get really bad, they can get way worse than that. But again, it's really important that you don't choke yourself out, okay? If you do set that and you hit it, which should not be happening all that often, by the way, because you're giving yourself some breathing room. If you do hit it, maybe, I don't know, a few times a year, maybe once a month, like at most, time to walk away. Okay, it's there for a reason. Respect it. Market will be here tomorrow. Question: what's the thing that took you the longest to get the hang of with psychology? As a new trader, there's a lot I've yet to experience with my psychology. Oh man, this is a big question because there's a lot of directions I could go with this, but I guess the thing that immediately pops out to me, the longest to get the hang of, I'm going to give you two answers. I'm going to give you a niche answer and a broad answer. Let's start with the broad answer. The thing that took the most amount of time for me to get the hang of was blunting my psychology to red versus green, especially individual trades, and like where I sit during the day. Today, if I start the day with a winner or I start the day with a loser, there's very little difference in how I feel going into trade 2. Okay. Now there is difference, of course. Like, you don't want to be red. I mean, we're still human, right? Like, it'd be great if we could just flip a switch and emotion all goes off while we're trading. But that's not real, of course. But it's so blunted at this point. That took the longest to get the hang of. And I anticipate, believe it or not, that it's just going to get more blunted in the future with bigger and bigger numbers. That should always be the goal, is to continue to desensitize yourself to bigger and bigger numbers every single year. That's the goal, right? I mean, get aggressive. Hey, every month, every quarter, whatever. You want to be desensitized further to bigger and bigger numbers. Now, the niche answer as far as charting, something that did take me a long time to get over psychologically was no longer always, in any market context, needing to be the contrarian. Here's what I mean by that. When basically everybody comes into the market, most of us, all you guys here are probably pretty smart people in and outside of trading, right? If you found yourself here, you're probably a reasonably intelligent person. And I'm being humble about that. You're probably a very smart dude or lady. Okay, and here's the reality. When you're really smart, sometimes it's going to work against you. And this is a warning. I'm giving this warning to you because you're that person. You're intelligent if you're here. Okay? It can work against you. And you start overthinking all this. And you start looking at the massive, ship that is NQ. Or the S&P. Or gold. And you start lacking respect for the amount of bias and money that is behind, and emotion, by the way, that's behind a trend. So in the early days, I had a really bad habit of trying to time bottoms and time tops. And sometimes it would work, which is why it stuck around for too long. But a lot of times you just get run over, and then it's not even the getting run over the first time that's the problem. It's the frustration that instills now. And now you can just go off the rails the rest of the day. You find yourself, 6 buys deep into a huge bear trend and continuing to do it. Stop out after stop out after stop out, and you're on your 9th try because you're like, well, now I just got to be right once, because if it reverses, we have all this room to make up for all my losses. And then you get stopped out again, and then you buy a 10th time. That's brutal. I've always kind of pushed back on the phrasing like, oh, the trend is your friend, because it always comes from the same group that says green is green, always take green. And we know how wrong that is. And they say no one ever went broke taking profits. And we know that for active intraday traders, that is a poison. That statement is a cancer to your trading. It's very bad. Because we know that ruins the math behind this. That ruins the statistics behind most people taking things too early. when the probability said you can leave this on for a bigger chunk. Doesn't have to be a massive chunk, by the way. It just needs to be what you expected to get when you entered before the emotion, set in. As much as I always, especially in the early days, pushed back on the trend is your friend. Today I might even use that phrase because I can pluck it and remove it from those other phrases at this point. But back then I kind of lumped it all together because I understood that like green is green, always take green. That was like total garbage that people spew just because I think, I don't know, it sounds good. And it was hard for me to detach when all those get lumped together in my head. But it's very, it's true. When the context, let's talk about this in a RAM, from a RAM perspective now. When the context is huge bear trend, depending when you're watching this, you might not know what I'm talking about, but I'm going to paint a picture for you. A few trading days ago, we had a massive, massive, massive trend. And it was basically the same trade over and over and over again. And it was a very good day for a lot of people trading RAM. It was a very good day for a lot of people trading RAM. And me in the early days probably would have been the opposite. Whereas I had a very good day taking continuation trade after continuation trade after continuation trade with the trend. Something that I was very guilty of in the early years that beat me up a lot was the old thought process like, well, it's probably not going to go too much further. Oh, if it reverses from here, there's a lot of upside, right? But that trend can always get just stronger and more emotional and more rational than you think, especially when we're talking intraday. When you set yourself up to try to capitalize on a relatively small move, all things considered, we're day traders, right? And you end up holding that thing for 5, 10, 20 times longer than you originally anticipated because you're like, here comes the curl, and you're still counter trend. Okay, now context in RAM always comes first. Okay, but when the context is trend, clearly aggressive trend, it's a rare case that there's going to be a trade that goes against that trend in almost every single case. I don't want to paint with such a broad brush and just say every single time in a trend it's going to be with the trend. But I could. According to RAM, basically every trade you ever take when the context is trend and it's hardcore trend is going to be with the trend. Whether you're buying, let's say a pull-in, and let's say it's a big bull trend. You're buying kind of a small bear close in the lower third of kind of a big aggressive big aggressive bull channel, which is basically classified as a trend in this imaginary case. You're still buying a bear close, but it's with the move. Or you're taking a basic 2 to 3 consecutive bull body continuation trade, very basic trade inside of RAM, of course, backbone setup. It's going to be with the trend. The only time you can get short in a bull trend is if you get minimum 2, but it better be more like 3, very clear, very, very clean, consecutive bear bodies that totally reasonably break the hope of that trend holding up, which is usually, and of course, there's no such thing as a certainty. But like, for example, let's say you had, the wick low of 34 here, and you had 35 kind of top out, and then all of a sudden you get 36, 37, and 38, and 38 is a big, strong bear body that closes beneath the 20 EMA and beneath these 2 wick lows. That's kind of what I'm talking about. Not that this is necessarily, it did turn into a bull trend. We hit this a couple of times today. At least I did. I hit 33 and 35, both winners here today. But like, that would be a case, you know what I mean? Like, it better be minimum 2 super clean bars. I hesitate to even say that because most of the time it's going to be like 3 consecutive counter trend bars that are really strong, growing and closing really clean, and also in the meantime clearing things like whatever you have up, whether it's a 20 EMA, and then also like the wick low, an obvious wick low that gives you a little bit more, quote unquote, the confirmation you're looking for to create that self-fulfilling prophecy for a further push. In a big bull trend, one little bear bar, two little bear bars that totally still respect the context of a bull channel, not nearly enough to start going short, according to RAM. Okay, so when the context is trend, especially if you're beginner intermediate, just think, okay, every trend I'm going to take right now, unless we get a huge consecutive bar shift, every trend I'm going to take right now is going to be with the trend. Right? Whether it's a limit order entry or a stop limit buy, or in a bull trend, or a stop limit sell in a bear trend, it's going to be with the trend until the context is no longer trend. Remember, according to RAM, always start with tier number 1, which is context. Then you go to tier 2, which is setup. Hope that helps. Question here. I got long at the close of signal bar 6 on the 5-minute chart. We are back on the 5-minute chart here. And this here is bar 6. Okay, let's look at it in the context of as it happened. Okay, got long at the close of signal bar 6, risking the signal bar, thinking at the time that 5 closed just above the wick high of 4, giving 3 growing bull bodies. Okay. So that is correct. 5 closing outside the wick, but still an inside close. Okay, 5 did show some insecurity with this wick back inside of the wick high of 1. I'm thinking, personally, when I'm seeing this, I'm thinking more, inside the close of 1 rather than outside the close of 4, but I understand why you said that, and I would also, take note of that. I'm just letting you know that in my head, there's a certain tier level that I kind of clock this into my brain, and this takes precedence. Insecurity, tried to break above the wick high of 1, sucked back, closed inside the break of 1. This is how I'm thinking about it. And then I'm like, but it did close above the wick high of 4. Let's look for bar 6 and see what we get. Bar 6 was a beautiful, big bull body, but it wasn't like tremendously large. This was not an 85-point bar, right? It was about a 30-point bar. Okay, within reason. Now, ATR at that time was 18. Now, this is a nuance that I think a lot of people are missing. When I'm looking at a trade like this, a lot of people say, well, how do you know if a bar is outsized? Well, here's a really easy way to know. If the ATR is less than half the range of the signal body, and we're, I'd say, not on like bar 3, where 70% of the bars being considered for the ATR, which has a period of 10, are pre-market bars. This, of course, is not that. This is bar number 6. The ATR is 18. The signal body's 30. Is that less than half? No, it's not. But, we're starting to kind of kick around in that territory. Okay, to be thinking about that. So, is it an outsized bar? Yes. Is it too outsized to not take the trade? No. Okay. This, getting long on the close of 6, is a reasonable, not the highest grade in the world. Okay. You got to remember, 4 and 5 were wiki bodies. 5 showed insecurity, sucking back inside the wick high of 1. And this bar is a little more sizable than I would prefer, given the size of 4, 5, and the current ATR at the time of this bar, which is 18.5. The range of the bar is 30. Okay, it's not, a perfect A plus RAM setup by any means, but this is a B minus RAM setup, okay? And it's logical to put that on if you can get a fill in the first, I'd say, about 20 to 25 seconds using a stop limit buy, 1 tick above the wick high of 6 on the close of 6. If you don't get a fill within the first 20 to 25 seconds of the open of bar 7, pull it, no fill, no trade. Let's watch how 7 closes up. If you do get a fill, stop goes beneath the wick low of bar 6, and you look to get probably closer to 1R. Okay, because ATR being 18 with 30 points at risk, I'd be looking with a bull body that strong, probably for at least a full R. which again, you're making a reasonable ask out of the market given the ATR being 18, which is why it's worth considering the signal body compared to the ATR, and why I tend, if I notice that, hey, the signal body is more, at least noticeably, more than double the ATR, usually is something that makes me hold off. In this case, it was kind of like in that range, but still workable. 18 compared to a 30-point range signal body on 6. And if you get a fill in the first 20 to 25 seconds on that stop limit buy on the close of 6 into the open of 7, great. Risk the signal body. 7, listen, guys, this trade, it was a reasonable, logical, moderately graded B minus setup. 7 just reversed like a mother. Crazy reversal on 7, right? Sometimes this happens. And guess what? A slightly higher probability or a slightly higher percentage of the time, you know what happens? You get a bar that looks something like 7, not necessarily that large, of course, but you get a move like this in your favor. That's why we're putting it on, right? Because there's a reasonable expectation of getting positive expected value on a trade when you get 4, 5, and 6. Again, not the prettiest setup in the world, but logical and reasonable. This one just happened not to work. If you took that trade and you're like looking at it in real time and you're like, yeah, B minus, but logical, I can make some sense of that. You should be proud of yourself, okay? Do not judge this is for day 2 traders who are completely missing the point of the business model of trading, who are going to judge themselves off of the success or not on a single trade. Do not do that. You're walking down the wrong path if that's what you're doing. You should judge yourself on your execution, okay? Not a low sample size result. Judge yourself on a high sample size result and the execution. That is what intermediate and professional traders do. Novice traders, beginners, day 1 type traders. They'll take one trade, it's a loser, they say I suck. Or even worse, they take one trade, it's not a very good trade, there is negative expected value on it from anyone who's looking at it from a logical and professional perspective, and it's a winner. And they say, ooh, I got this down. You know how dangerous that is? Not the boat you want to be in. All right? Logical trade, just understand, again, the nuance, B minus setup, not the prettiest trade in the world. It just happened to turn around aggressively, and hey, that is okay. Live to trade another day does not mean you do not have positive expected value. Again, get your value not from a low sample size result. Do not do that. You're shooting yourself in the foot. Get your value and your self-worth from your discipline, your patience, your execution, and remembering that you have positive expected value when you do all those things within logical reason. Okay? Be very careful about that. I'm serious. I'm going on and on about this because this is a really big deal. Okay? The high sample size result, the large sample size result is what matters, not the 1 or 2 trade sample size result, as well as, the discipline, the patience, and the emotional maturity, right? The sizing. Make sure you're not trading way too big for the prop account size that you're running, or in a personal account, of course. And the high sample size result is what matters. All right? You take that trade, you say, wow, interesting. Man, 7, respect to the bears, and you move on. And you don't take it personally because you look in the mirror, you say, I know I have positive expected value. Big deal. I lost one trade. Professionals lose thousands, tens of thousands over their career. It is a privilege to be able to lose that much. You know why? Because you're making a bunch of money because you're able to keep losing and you're winning even more. All right, those are my thoughts there.